The number 7, that's how many times has been incorrectly predicted so far that the Federal Reserve will pivot. But there's more to that number than meets the eye. With 7 VIX expirations now in the bag, what is the stat that we tend to see next? More importantly, will the S&P 500 be able to make a new high? And could we ever actually see pullbacks back to these green box zones? Today we cover that along with stocks, commodities, and cryptos as we explore what's happening to Tesla right now and the pullback after the gap fell, whether there's a sign of weakness coming from small caps after hitting one of our critical resistance levels, and of course whether home builders are showing us that weakness is on the way. That and more coming up in today's show. Well, welcome back everyone to the Daily Show where we talk about macro lead indicators and the hottest charts daily. Remember, if you like anything to do with markets, subscribe and also have a look at our new newsletter, which is completely free. Links in the description down below. There are limited spots for our launch, so make sure to take advantage of that. And it's as easy as name and email address. Let's talk about the 7 times the charm. Basically, this is a number that we're going to say twice today because the stats are pretty exciting. Have we called or have we seen people call pivots many times over the last couple of years? Quite simply, yes. And that's left a lot of doubters out there, like I'm sure you could be in the audience right now. The one thing, though, is that even though we've seen so many times calls for pivots, this time could be a little bit different. And it has to do with the price action that we're seeing on the charts, both from the bull side in the markets and also from the yields themselves. Let's talk about one of the other stats that we tend to see when it comes to 7 times, and this has to do with VIX expiration. Remember, max pain is less than 24 hours away at the time of this recording, and what that usually brings is trillions of dollars of expiration. But more importantly, 1, 2, 3, 4, 5, 6, and now 7. We've seen 7 VIX expirations, which have now happened, and generally speaking, we will go to a sideways market to down market after this period. So next week is certainly in focus when it comes to VIX expiration. If there's going to be weakness, you might be noticing throughout today's video, that would be the time that we would usually expect it. Let's talk about why we might expect such a thing. This is the Dow Jones Options Expiration OPEX. What happens on the Friday? Well, it turns out that generally it's actually up on the options expiration. However, I'm not sure how good that stat would be. The next week, though, after the options expiration is actually only 12 times up, 9 times down. Now, if you know your stats on markets, to see a 12.9 is still not, while not negative, still not exactly a super positive week. And you'll see that when we go to seasonality a little bit later on for the markets themselves. On the flip side, the Russell 2000 actually does tend to do a little bit better in the week after. So there could be what we call rotation going on in the markets. And we will be absolutely eagle-eyed for that, because if rotation starts to happen, we could be moving into what's a classic, which is a rally followed by some kind of recession potential drop in 2024, which is going to make it a very good traders market. Let's talk about bullish sentiment. And yes, the results came in very bullish. A lot of you excited if you're thinking about pullbacks in the market for valid reasons. 43.8% of respondents went bullish after one of the biggest flip-flops that we've seen in some time. 50 bears to 42 bulls, and now we've got 28.1% bearishness. If you're interested in seeing some of these things, by the way, follow us on X, links in the description down below. So why could the Russell 1000 or 2000 or any of these small caps be the possibility of leaders? Well, it turns out that we are in a point now where markets do tend to go into the bullishness for the Russell. The reason, it's got to do with the time of year, but here's a 3-month forward return based on the percentage of current issues above the 50-day moving average. This is taken from 1979 all the way to 2023. And you'll notice that there is a 784 to 341 win-loss ratio. Basically, 70% of the time, markets will be bullish over this period with an average return of 6.6% over the next 3 months. Does that matter? Well, it does come into consideration when you think about this. And of course, the market has since done this, and we are right here. In fact, we're actually where the writing is. So there you go. We are basically at the end of November. Technically, during mid-December all the way to February, you tend to see a run. Now, did we see that in 2022? The answer is quite simply not really. We didn't really get a super rally. And of course, the Russell was one of the laggards over the rest of the mega caps and the medium caps and anything else really, but it might be time for it to shine. If it's going to, generally through that December into January period, you can see some statistical strength. Let's now talk about another number. We've talked about 7, let's talk 5. We brought this up in our previous video, and this is because it's such an incredible stat. If the Federal Reserve does choose to hold rates in December, that will take it to a 5-month hold. We've never seen the Federal Reserve hike after a 5-month hold. So with, I think, a 0% chance, according to the markets anyway, or according to the respondents, on a chance of a hike in December, that's why it's a little bit different. But don't stop there. Of course, 14 times we've seen this before, and 11 of them ended in recession. So recession, very low chance of soft landing. What do you think, though? We'll put a poll out. You guys should vote. We'll see what your opinion is. I'm very interested to bring that to you in the next video. So make sure to vote with your click finger, I guess. Let's talk about what's going on with yields. Now, is this another sign? We've seen what we call a first time frame change of trend on the US 10, 20, and 30Y yields. Now, also Treasuries most notably is getting a lot of activity on it, and for good reason, I think, but also more importantly, some big players have started to get rid of their bearish bets and go towards the bullish side. That could all be a sign of lead up, but really the US 10-year tends to lead. So if we see fall off, which we are starting to see, it tends to lead that the Federal Reserve is around to cut. Now, this is where it gets even a little bit more interesting because, of course, unemployment just arguably started to spike back up again. Now, if that's true, that usually marks around 6 months statistically from somewhere around a recession call. Now, a lot of people, including Goldman Sachs, are saying Q4 of next year is when the Federal Reserve is going to cut. Now, we know that all these predictions are flip-flopped all over the place, but it will be a very interesting read because it could make for a very big 2024. And this is one of the reasons why. If a Fed cut does come in, it's not really good. It means something broke. Remember, the Fed doesn't cut out of the goodness of their heart. They say, whoops, we overdid it and we broke something, and now it's time for us to cut and hopefully support the markets. If that is to be true, then generally the markets will fall. An average return is negative 23.5% over 200 days to the low. However, we could, of course, get out of it with less than that based on some previous times. What do you guys think? Let me know in the comments down below if you think it's going to be brutal or it's going to be okay. So what's going to happen moving forward over the next couple of months? Well, a lot of the breadth and thrust stats that we're getting right now suggest decent markets. I mean, 4 unfilled gaps of plus 0.5% in 3 weeks, you'd think, well, that needs to be filled. Well, the statistics show that generally speaking, markets continue to pile up and actually move higher. And this is a problem that's going to be. It's going to be timing is everything here if you are to say that there is going to be a sell-off in 2024 or anytime soon that's actually significant. It's more likely than pullbacks will be met by bull demand based on the current stats, and then 2024 could be totally different. Remember, what is actually trending right now on Google, X, and all these other platforms is recession, the word recession. Now, do we ever see a recession when people talk about recessions? Probably not. It's when people don't talk about them. So remember to have that US 02Y versus US 10Y on your charts. That is a very important indicator. And of course, we'll talk about it here on the channel. So make sure to subscribe. We'll talk about it when it does occur. Why are the markets moving up? The simple fact is that this week was huge amounts of options expirations and a lot of money at stake. We saw puts coming in on a monster scale. Now, once we see so many puts, it's not really best to pay off those. Who writes these contracts? A lot of the time it is the banks, so it is better to have the markets higher. We also know in consideration of melt-ups that 7, 8, 9-day melt-ups like we saw with that super strong strength tend to result in a slowly grinding up market. We have hit the grind point now. Will we see a slow grind, or are we going to actually see a little bit different to this where it's more of a nice, steady kind of movement down first, followed by a rally? 2023 has been different, so it is possible to do that. Just a reminder, another thing that we've been talking about a lot is gold. We're still, in my opinion, a short squeeze, and I wouldn't be surprised at all over the next 2 years to see gold really slam past not only all-time highs, but potentially even get into that 2,800 to 3,000 an ounce. Now, of course, I don't often make big predictions or anything, but I do think it's possible based on how long that metal has stayed low. And also if we do get a Fed pivot and cuts and move into a commodities partial boom, whether it's actually stagflation or a cut cycling, usually gold performs okay. We'll find out whether it can actually be let free or it's going to be manipulated all the way back down again. Here are some other big stats for bulls. Of course, you'll like this one if you're a bull. When we have similar years such as 2023, November 15th to December 31 was positive 27 to 3 times. So again, the stats for the shorter term or medium term look pretty positive. Here's our stat for percentages to do with what's going on with yields between November 6 and 26, which we kind of expect it to go down. So that is what's happening. And of course, we mentioned the seasonality before. If we're going to see weakness, it usually happens next week after or around the OPEX options expiration. So we'll be on top of this one should we keep seeing some weakness in some of these key sectors, these key leads. Let's talk about big dark pool transactions then, shall we? IVV. The iShares Core S&P 500 ETF. Yeah, huge trade, guys. Big one right at the high. Could it be a sell? There's a decent chance it could be. And of course, it's right where we're starting to make that structure. So that's a good sign if you're feeling a little bit bearish at the moment. Another one, AMD coming out of nowhere. 2 massive transactions. Could they be buys? Of course they could. But they are weirdly at the highs. And of course, we often do see buys when we're forming a base. And sells when we're forming kind of like a take profit zone. So that's interesting. And then, of course, we have Vanguard Treasuries. So Treasuries getting some more trades on it. A huge trade coming to Treasuries. Is that a take profit or is that a breakout trade? I'm not too sure. Statistics, the way the market looks at the moment from Treasury standpoint, could be either, but still a significant trade coming in. Some other ones are oil. Will oil sell be over soon? Well, it has been pretty brutally sold. We've talked about a lot of selling at the highs. Heaps of people were bullish on oil. Obviously, we turned to the negative side when all of that stuff broke out. Often it does the exact opposite of what people think, and we saw that in that price action and selling. And of course, we also get biotech still seeing some big transactions going on. Right at the close, we've got biotech placing a big trade. Will biotech finally place a turn? One of the worst sector performances ever for it, and it really has been sold off ultra hard. So if we do see a Fed pivot, if we are on that time, biotech would technically do okay from lower interest rates. Most of those companies make no money anyway. Let's move over to the options, and we see a pretty lackluster Thursday. I will admit, I think that Thursday was going to be a bigger options day, and it just wasn't. So will that mean Friday is actually the volatility day? 38.5 million in comparison to 40, which is now the average. Again, a lot of calls coming in. I would say this is retail stacking on as well as, of course, bigger players, but 53% calls. So it's been a few days now of extra high calls as we saw that melt up occur and everyone gets really excited about the markets. These are some of the biggest transactions. We saw Intel getting some big transactions up 6.7%. Obviously, call side buying was strong there. And there was quite a few other notables that were coming through. Walmart and Cisco both showing some really bad sessions here with 7 times the options volume plus going through on those markets. Another one that was interesting was to see Enphase actually drop. It's had 2 really amazing sessions on it, and then of course some weakness there. And the iShares Russell 2000 continuing to get just monster options transactions on it. Let's have a look at the best performer. As we kind of expected, gold came through and it was shiny and it was a nice island reversal. I talked about this in our Market Masters Club. It was probably my favorite of the last 24 hours. I really like the setup on gold stocks. So nice to see it rallying up, but it was defensive in nature. Gold, utilities, okay, yeah, sure, tech was there. But then we had healthcare. Then we had some other ones as well coming through. Wasn't the best for clean energy and solar. So some of those markets, and of course, energy continued to get shunted in this market. 5-day average, solar's the best. Home builders doing really well. But that's where the weakness started, home builders. Let's get into the charts. Advanced decline, first up, bad. That's how it is. It was down. Yeah, it might not look like the market moved much, but that's not exactly what you want to see. A lot of stocks falling off while some were holding it up. Did we see anything from our orange squiggly line here, the Bank of America effective rate? No, we didn't really see too much shift. Obviously a little pickup, but not enough to write home about. And put-call ratio remained into these lows, showing us that, of course, calls have come back into the market pretty big time. Let's keep going through some other charts. We've got percentage of stocks obviously dropping off across the board, still sitting at 72.46%, but we have done a rotation with percentage of stocks above. And as you would note, if you go back and have a look at some of these dates, they can sometimes mark around high or structure forms. So are we at the overbought? Yeah, arguably we are. When you look at percentage of stocks above 20, we're starting to see a little bit of rotation through. The VIX didn't jump much, so that's important to note. And we always want to look underneath the hood, either at the VVIX or the MOVE, and the MOVE was not jumping either. So it's not like volatility was increasing across the board. US 2 versus 10, no change. Obviously not underneath the magical 1, so we don't think recession is coming anytime soon. And then we move over to treasuries, where we basically see still a pretty strong treasury market. I've liked treasuries down here, huge volumes, pretty exciting. I think a lot of us like the big volumes. And of course, there's some notable, I think it was like Bill Ackman's, a few other people trading around these lows. We also see kind of like a giant island reversal down here as well on the ETF, showing us that I think momentum and possibly even the lows for treasuries could be in. It's the first positive, really positive sign that we've had in like 40% sell-off on treasuries. High yield junk bonds weren't doing too bad, up 0.13. Corporates doing okay as well, almost making, well, I think they did actually make a new high. So again, the bonds market wasn't exactly getting shunted through this market. And we also saw yields across the board, of course, drop. So the 10-year now almost at a new low, 4.433. And you really shouldn't celebrate the 10-year coming down like this because it means something's a bit wrong, especially if we're still inverted. But it is, and the market's obviously like that, at least initially, and that's what history has shown us. RSP equal weight was down both on the S&P 500 version and, of course, the Qs. But here's where it gets interesting. Look at these sneaky central bankers. Oh, we'll just casually do some injection. You know, it's okay. It's okay, guys. Everything's fine. You know, the picture of the fire and the burning dog thing. Yeah, I don't think it's that fine. What is this? This looks dodgy to me. Anyway, we've got two massive injections coming through, and that's helping, I think, to support the overall market. We saw, of course, the first injection happen over here, claiming us to basically say, well, maybe there's some speculation of breaks. We saw similar kind of periods where we got this during the break of March. So it kind of makes me think something's broken. They already know it, but maybe we don't know exactly what it is. Maybe you know what it is. Put it in the comments down below. I'm sure there's going to be some interesting ones from that. Dow Jones Transportation Average was not going up. It was going down. So again, that's showing us that there could be some weakness under the hood. And as we mentioned at the start, home builders also seeing a double wick rejection up here in these highs. So double wick rejection, follow through maybe in the next session. Certainly not really pointing towards super bullishness. Maybe it's just pullback for now, which seems the more likely kind of road. But yeah, that's what we're seeing here on home builders. Now, if home builders were to break those highs and close, that'll be significant for the rally crowd. Another one I've been liking recently has been commodities. I've been kind of talking a lot about iron ore. I've been talking about copper. And in general, I think these markets, we could be in like a multi-year boom. So if you're a stagflation player, technically commodities have been pretty good during that time. And a lot of them are kind of in the dirt at the moment, if you get what I'm saying, and they're not doing so well. So yeah, copper, iron ore, some of these particular markets starting to show some signs of strength on the charts. Iron ore is certainly worth a look as well when you look at it on a chart in terms of breakouts. Dollar index still floating around this area, so it's not really doing anything in particular. It's sold off heavy, it's consolidating, new lows, probably pushes into something in terms of the demands down here. So you're looking at about 103 is the next stop for the dollar if we keep seeing weakness. This ended up being good for gold. Now, there was a short on gold you could have taken right there, and you can see there's a little reaction to it. Of course, on the medium term and long term, I am bullish on gold, but I wouldn't have blamed anybody for taking a short there. It was okay, and there were some signs maybe it wasn't going to work when it took out this high, but there is a replication there. It's probably a 6 out of 10 style replication that you're going to get, and it would have been nice to see it come back into this demand and then, of course, rally back through on the spot. But where the really great trade was actually the reversal of that, which was just to say, okay, gold stock should be going up. And it was up 1.5, it was up actually more than that during the session. Really nice base. A lot of you will see this as an inverse head and shoulders pretty correctly. There's a few other things going on there on the chart, but gold looking better as the stocks. Where it got really bad, though, was oil getting destroyed. Back down to most traded level number 2. Actually hit it perfect. And yeah, this one was kind of foreshadowed after we took out our little demand. So, of course, here was where we took it out. This was certainly a great trade. A few people had this one in the short. I didn't really do anything with it in this case, but I have been generally negative on oil. This was really where I started to see a little bit of positive sides. Then, of course, got broken even on this area and back down to the most traded level number 2. I'd be looking for structure here, though. it could be that oil selling is almost done for now, and we're starting into this good structure rotation. So we'll be on the lookout for oil. Could get exciting soon. Speaking of oil, or EV in this case, we're going over to Tesla. Now, probably there's quite a few extra things going on here that are not quite technical, but generally speaking, we did move towards that gap fill. We started to get confused, and I don't like confusion. So, of course, we've now seen the markets going down from this point with Tesla. Rivian, I think, also lost during the session. And we did have a gap up and then, of course, a gap down. I do think it's possible for Tesla to move back down to 225. And this will be an interesting zone to see whether buyers recommit. I don't really like it around this area in particular. And I'm not sure what you think in the comments, but I don't really like that zone. IBB or biotech, no breakout yet on trend line. Obviously, some big trades on some of the more leveraged biotech contracts. What about the market indices? We'll start off here with the Australian market. Of course, we have a shooting star and we're falling off. A zone to watch will be 7,000, which is a psychological zone to see whether bulls will recommence. But let's move over to the US market here straight away and talk about this Russell 2000. So we see the rejection, which is a rejection pin or shooting star, coming off that previous level of support. And obviously, psychological level, 200 daily moving average, all sorts of things here. Now, if we go down to something like a 15-minute chart, what you'll notice is that you do get some structural selling that's occurred here. You've basically seen the market kind of go up, breach, go down lower, obviously change on some of these timeframes, and now rallies. You would think maybe 1800 could be met by sell demand. It's not the most beautiful setup. Some people just like to be bullish. I don't blame them. But this is really the question mark. The stuff from the CP, I just have to say CPI number, the CPI number, because over here we have this huge pre-market transaction. That's a gap, obviously, and this is a great base that we saw form, of course, as demand. So really throughout most of the indices, it would be nice to see these fill up, and that's what I think a lot of bears are looking for, fill these zones and then possibly find buyers again. Here's the NASDAQ, again, very similar. I don't like using the NASDAQ particularly because see this little low here? That's exactly where it bounced off, and it makes you just confused. Now, I don't mind trading the NASDAQ, but I do like to usually see the S&P 500. So let's jump on over to the S&P 500 here and have a look at how it's traded. So where is it right now? Well, it did sell to a new low, like we spoke about in the last video. So once we saw that, which happened, I'm just going to draw it across. Actually, was that a new low? Just need to make sure on that one. Let's check that out together right now and just make sure that's right. Oh, no, it didn't. So no new low, unfortunately. I wasn't sure if I got an alert for that. I did not, it turns out. So there's the new low, and we would need to see that actually getting cleared. At this stage, market buyers are still in control. Notice the difference between this a little bit in the NASDAQ and the Russell. The Russell's showing, okay, weakness down. The NASDAQ showing pretty similar to this, except harder to see. And the S&P 500's right on those low demands with that rally coming back through. So unfortunately, for a bear, you're going to look at this and say, well, yeah, okay, you could potentially short here with stops above the high or some kind of option contract or something. Wouldn't be the worst. But really, what did the market tell you? Well, the market said, hey, I'm still bullish, dude. I'm going up. And if I do pull back at this stage, I'm in the rally fest. So I might want to melt up, form some kind of Wyckoff top, UT this thing, or UTAD it, push higher, then come down later. And that's the problem with trying to go against a market. At this stage, it is bullish, 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 and there's not much you can do about it, even if you have an opinion that this 45.12, 45 would stop the market. Of course, this is the zone we were looking at to stop the market, but so far, not enough evidence. We will be continuing to look at this one and, of course, watching it, but 44, 80, whatever it is, 86 or 85 is an alert that you should have on your charts, and make sure not to delete it like I did, okay? Don't do that, guys. Let's move over to Bitcoin. Oh, just quickly on US 500, we need to go back over to this. So let's just quickly talk about where we think the markets could go back to. So obviously we get that CPI data, which is here. So I've drawn two green boxes, which are, of course, the most hopium kind of versions that we'd like to see. This one here, 4,400, a psychological level. Also, as it turns out to be maximum pain. So let's actually have a look there. We're going to refresh this together so you can go and find out this. Now, maximum pain, again, third week options expiration. You're going to be wanting to look at that 17th. You can see the total open interest amount's huge, and then you'll see these huge spikes of puts and calls. So if we were to, I don't think we're going to get maximum pain, even though that's at creeping up now to 435. So it was 430 at the start of the week. 440 though is the interesting one. Could the market sell off and close here? I would say the markets would be very happy with that number if they were able to get it. And yeah, 440 is probably one of the most important zones in the charts right now. Not only is it where buyers could recommence if they want to keep melting up without getting too much pullback, but it's also where options expiration would probably make a lot of money after all things are said and done. Let's now move over to the crypto world. No Ethereum breakout yet, did pull back. And of course, Bitcoin still holding 36.5 after a drop and then a huge rally back to 38. And it just couldn't get through, could it? It just sold directly off that resistance high. However, it still remains in a higher low. It didn't make a higher high. So the trend remains bullish for now. Some people will probably be screaming at the screen saying, Tom, it's going to be a double top. I tell you, I don't know that. Maybe you do. I don't know that just yet. So we'll be, of course, watching it as much as we can. That's pretty much the news for the week. As in regards to new news, though, maybe check out our newsletter and, of course, subscribe to the channel. Free. Click on the links in the description. Click the alert button. We'll see you in the next one. I hope you enjoyed today's video. Good luck into OPEX. And, of course, next week, that's the one when the stats turn a little bit more of a pullback kind of focus. At least that's what's happened in previous years. As always, stay safe out there, guys. Practice risk management. See you in the next one. Bye for now.